Hello everyone, welcome to today's lecture video over Chapter 4 titled Mutual Funds and Other Investment Companies. So in Chapter 3 we discussed how securities are traded, so we talked about the different markets, different systems, different types of trades. However, a large percentage of investors choose to invest with investment companies instead, who will then purchase the securities on their behalf. So this chapter focuses on those investment companies and the different types of offerings that they provide. So first of all, different types of investment companies. We'll discuss mutual funds, which are also called open-end funds. We'll talk about unit investment trusts. We'll talk about hedge funds and also closed-end funds. And then we'll turn our focus primarily to mutual funds. So what are their functions? What are their investment styles and policies? What are the different costs of investing in a mutual fund? Look at their performance and also where can I find sources of information on these different funds. So first, to set the stage of everything, let's talk about investment companies. What is an investment company? An investment company pools and invests the funds of individual investors in securities or other assets. So the key there is that they pool and invest the funds of individual investors in securities or other assets. So the pooling of the assets is the key idea behind investment companies, and then as an investor, you have a claim to a proportional amount to what you invested. These investment companies are simply financial intermediaries, so they are acting as a middleman between two parties in a financial transaction. And with these investment companies, they actually perform four important functions for investors. First, the first important function that they provide is record keeping and administration. So they will provide information about different types of investments, and then they may also actually reinvest dividend income for their investors. Investment companies also provide diversification and divisibility. So as an investor, you can actually hold fractional shares in many different securities. So if you think about diversification, it would be difficult to have a well-diversified portfolio and be required to invest in total of all these different shares. What these investment companies allow you to do is allow you to have fractional shares and be able to overcome that financial hurdle of what it would cost to actually purchase whole shares to gain that same diversification that these investment companies provide. Additionally, they provide professional management. So these companies can actually employ full-time staffs, something that an individual investor would most likely not be able to do. And as a result of trading large blocks of securities, they can provide lower transaction costs. So just for some context, let's take a look at the largest asset managers in 2017. So the largest investment companies here, you can see BlackRock was number 1, Vanguard 2, UBS, and you can work your way down. But you can see here that there is a substantial amount of assets under management of these top 10 companies. So these investment companies are certainly have a large amount of assets that they are managing for their investors. So before we get into the different types, let's talk about a key calculation that we'll be looking at here today, and it's called net asset value. So these investment companies, as we mentioned previously, they pool the assets of individual investors, but they also need to be able to divide the claims to those assets among the investors. So how do they do so? They do so by calculating a net asset value. This is simply the value of each share in the pool, and the number of shares that you own then represents your claim on the underlying assets. We'll talk a lot more about net asset value and how it's utilized in transactions. But first, a quick calculation of net asset value. It is simply the market value of assets minus the liabilities divided by shares outstanding. So let's look at a quick example. Consider the balance sheet of the Vanguard Growth and Income Fund in March 2011. They had assets of $3,352.8, liabilities of $270.3, and shares outstanding of $110.2. So one of your homework problems talks about assets here, and it simply tells you that a fund has 4 different securities, and they tell you how many shares of that security is in that fund and then the share price, and they ask you to calculate net asset value. To calculate the asset value, let's say we have 2 stocks in our fund. So stock A and stock B are the 2 stocks that make up this fund. Let's say you have 100 shares of A at $30 a share, and you have 100 shares of B at $20 a share. So all you would simply have is $3,000 total in stock A, $2,000 total in stock B for total assets of $5,000. So in this particular problem, I give you the total assets. In your homework, you're going to have to calculate the total assets first to calculate net asset value, but it's a rather straightforward calculation. So getting back to our problem here, Net asset value is simply the assets minus the liabilities divided by the number of shares outstanding. So for this problem, we can see that the net asset value is $27.97 per share. Something that is key and comes into play when you are trading, depending on the different types of funds that you are purchasing. So our next discussion, now that we have introduced net asset value, is to turn to the different types of investment companies. So these companies that are pooling funds together. So the first type of, I'm going to reference this chart periodically throughout the next couple of slides. Investment companies are required by the Investment Company Act of 1940 to register or be classified as either a unit investment trust or a managed investment company. This other investment organizations area down here is the third type of investment company. These are companies that are not formally organized or regulated as investment companies, but they do serve a similar function. So what we'll be doing here on the next couple of slides is just going through the different types of investment companies and what they offer and some different characteristics. First is a unit investment trust. So unit investment trusts are pools of money invested in a portfolio that is fixed for the life of the fund. So the portfolio composition is fixed. So typically in these unit investment trusts, they will purchase one particular type of security. So for example, municipal bonds or corporate bonds. And then as an investor, you can include these in your diversified portfolio. The big characteristic of unit investment trusts are that they are unmanaged. And they have actually had a they have lost steadily market share over the past few years. You can see that their market share has declined from $105 billion in 1990 to $85 billion in 2017. So key is that the portfolio is fixed and that they are unmanaged and they are unmanaged trusts. The second type of investment company then are these managed investment companies. So the unit investment trusts were unmanaged. Managed investment companies come in two different types. You have open-end funds and you have closed-end funds. So with both of these funds, the board of directors is elected by the shareholders, and then these companies then both hire management companies to manage the portfolios on their behalf. So they hire these management companies to manage the portfolios, and these management companies then charge a fee. So it's typically anywhere from 0.2% to assets under management to 1.5% of assets under management. But this is something that must be considered when you're talking about open-end funds versus closed-end funds, is that oftentimes the management company will hire, or the companies will hire a management company to manage the portfolio for some fee. So let's talk about the differences, and we'll talk about fees a lot more later on. Let's talk about the differences between an open-end fund and a closed-end fund. With an open-end fund, this is essentially your mutual funds. They stand ready to redeem or issue shares at the net asset value that we calculated previously. So the shares in an open-end fund are priced at net asset value, and so as an investor, when you're ready to cash out, you would simply sell your fund back to the fund issuer at the net asset value. So with the open-ended funds, the number of shares outstanding will fluctuate daily since you are selling it back to the fund issuer. On the other hand, then you have closed-end shares. With closed-end funds, you do not redeem or issue shares. You can only buy on a set date. So when there is a new issuance of the closed-end fund, and so the shares outstanding is constant. So as I mentioned previously, open-end funds, the shares outstanding fluctuate based on if investors have sold it back to the issuer or purchased it back from the issuer. Whereas with closed-end funds, these shares outstanding are constant because they are traded on an organized exchange. So they can be purchased through a brokerage, and with these closed-end funds, they are priced at premiums or discount to their net asset value. As you'll see on the upcoming slides, oftentimes they're priced at a discount, which is kind of puzzling and something that is not fully explained, but you can see that the prices of closed-end funds often fluctuate from their net asset value. So let's take a look at the main differences between open-end and closed-ended funds. As I mentioned, with open-end funds, their shares outstanding change when new shares are sold or when shares are redeemed, whereas closed-end funds, there's no change unless new stock is offered. So if you want to cash out, you have to find another investor that's willing to buy it out in the secondary market. Then with trading, the trading of open-end funds, you buy or purchase it from the actual fund, whereas closed-end funds trade on an organized exchange, just like a stock. And then with the pricing of open-end funds, their price is their net asset value, whereas with closed-end funds, they can actually fluctuate. Let's look at that fluctuation. So these closed-end funds will sell at either a premium or a discount, and it is simply the percentage difference between the price and the net asset value. So to calculate the premium or the discount on a closed-end fund, you would take the current market price, subtract the net asset value, doing the same calculations that we did previously, and divide it by the net asset value. And just taking a look at this chart here, you can see that we have, 7 or so different funds and their net asset value and their market price. And as I mentioned previously, many of these closed-end funds actually sell at a discount to their net asset value. So those are our managed investment companies. So that's our open-end funds and closed-end funds. The third type of investment companies are those others. So as I mentioned previously, these others are not formally registered as investment companies, but they do serve similar features. And so the different types include commingled funds. With commingled funds, these are partnerships of investors that pool funds together. So these are very similar to the open-end funds that we discussed, but instead they offer units that are then bought and sold at their net asset value. So these are partnerships of investors that pool funds. There are also REITs. REITs are simply your real estate investment trusts. So these are very similar to your closed-end funds, and you have equity REITs and you have mortgage trust REITs. So with equity REITs, they invest in real estate directly, and with mortgage trusts, they invest primarily in mortgages and construction loans. So as the name kind of suggests with REITs, real estate investment trusts, these different funds invest in real estate or loans that are secured by real estate. Okay, so that is our other investment organization. And then lastly, we have hedge funds. With hedge funds, these are vehicles that allow private investors to pool assets to be invested by a fund manager. So with hedge funds, you have active management. They also utilize sophisticated investment strategies such as shorting and buying on margin like we discussed in the last chapter. And as a result of the riskiness of hedge funds due to their sophisticated investment strategies, these hedge funds are only available to accredited investors. So accredited investors are high net worth investors, so a net worth of greater than $1 million or annual income of $200,000 or $300,000 if married, and large institutions are also considered accredited investors. But those are our other investment organizations. So we've talked about investment companies, these companies that are pooling funds together, and the differences between your unmanaged unit investment trusts, your managed investment companies, which are your open-end funds and closed-end funds, and then lastly, those other investment organizations. For the rest of the chapter, we kind of turn our focus primarily to mutual funds. So let's focus on mutual funds and discuss their different features and how they operate. So with mutual funds, this is a common name for open-end investment companies. They are the dominant, so open-end. This is the dominant investment company today. They account for 87% of investment company assets. And in early 2018, you can see that their assets under management were $18.7 trillion in the U.S., and in the non-U.S., they were $25 trillion. So with these mutual funds, each fund has a specified investment policy. So this policy is then described in the fund's prospectus. And what we're going to do on the next two slides is discuss some of these commonly classified groups or policies that these mutual funds actually embark. So the first would be a money market fund. With money market funds, they invest in money market securities such as commercial paper, repurchase agreements, or CDs. Let's also include treasury bills here as another security in the money market funds. So the average maturity of the securities in a money market fund is a bit more than 1 month. And then these money market securities are considered prime or government. So prime securities would simply be like your commercial paper, your bank CDs, whereas your government securities are your treasury bills. The second type of investment policy would be investing in equity funds. So these invest primarily in stock, and these different funds are typically classified on capital appreciation. So capital appreciation being your growth or your income fund. So these are your high dividend funds, so capital appreciation, or they are classified as current income. So these are your growth funds. So these would be the ones where you forego current income for capital gains in the future. The next investment policy are sector funds, which concentrate on a particular industry or country. So particular industries such as biotech or utilities. These are sector funds. And then you also have bond funds, which specialize in the fixed income sector. So your fixed income, your debt securities, so corporate securities, treasury bonds, mortgage-backed securities, municipal securities, all examples of funds invested in a bond mutual fund. We also have international funds, which focus on global, international, regional, so a particular part of the world, and emerging markets, which are simply your developing nations. We also have balanced funds, which are designed to be candidates for an individual's entire investment portfolio. So they hold both equities and fixed income securities in relatively stable proportions. You can have aggressive versus conservative balanced funds based on your life stage, and you can also have target date funds, which are based on how old you are and what your goals are, but these are balanced mutual funds investment policies. There are also asset allocation and flexible funds, which hold both stocks and bonds. The key about this asset allocation and flexible funds is that they are engaged in market timing. So these are not designed to be low risk. It's often argued that it's very difficult, if not impossible, to time the market. These asset allocation and flexible funds do engage in market timing, and so these are not low risk mutual funds, or not low risk mutual fund policies. And then the last one that we are going to discuss are index. These are where you try to match the performance of a broad market index. So, for example, the S&P 500. With these index funds, about 25% of equity funds in 2018 were actually indexed. Now, you can index other securities that are non-equity, but just a little context there in regards to the percentage of equity funds that are actually indexed to some broad market index. So looking at mutual funds by investment classifications, just kind of breaking it down a little bit further, you can see you have your equity funds, your bond funds, your hybrid funds, money market funds, and just what their assets under management are, and then a percentage of total assets in these mutual funds. Now, what are a majority, or what do most mutual fund investors actually invest in? You can see that retirement is the big one. So retirement is a key focus on mutual fund investment, and you can kind of see the different breakdowns in 2019 of what most mutual fund investors are focusing on. So continuing on, how are mutual funds sold? So if you want to take a quick break, now would be a good time just to kind of refresh and review what we've covered previously. Now what we'll turn our focus then to is how are these mutual funds actually sold? So mutual funds can be sold in a variety of ways. First, they can be sold directly by the fund underwriter. So this is like direct marketed funds. So these are sold through the mail, various offices of the fund, over the phone, or over the internet. So with these these funds that are sold directly, investors will contact the fund directly to purchase shares. Whereas we also have indirectly distribution, which is through brokers acting on behalf of the underwriter. So your sales force distributed would be an example. About half of mutual funds are distributed through sales forces. So with this indirect distribution, brokers or financial advisors receive a commission for selling shares, and as a result, this could provide or present a potential conflict of interest. So these brokers would be selling a particular fund primarily for the commission that they would receive for doing so in this indirect distribution. And then mutual funds are also sold through financial supermarkets who sell shares in funds of many complexes, and instead of charging a commission, the broker splits management fees with the mutual fund company. Many will argue, though, that this results in higher management fees being charged by the mutual fund company, and if there's higher management fees, then that would result in a higher expense ratio, which is simply your operating costs relative to your assets under management. And we'll talk about these expenses in more detail here on the upcoming slides. Actually, on the next slide. So the cost of investing in mutual funds. So when you are looking at mutual funds, you should not only consider investment policy and past performance, but you should also look at all the different fees that are other expenses, all the other fees and expenses. So I apologize for that bullet being already up there. My timing's a little off, I guess. So first of all, the different types of fees that are included with mutual funds. First would be operating expenses. So these include your administrative expenses, your advisory fees. What's key or unique about these operating expenses is this is not an explicit charge. So this is something that is deducted from the assets in the fund, and as I mentioned previously when we were talking about expenses of open-end and closed-end funds, these range anywhere from 0.2 to 1.5 or 1.5% of actively or of assets under management. And one thing that you'll notice, and we'll talk a little bit more in a second, is that those active managed funds are actually higher operating expenses. You could also have a front-end load, which is a commission or a sales charge that's paid when you purchase the fund. You could also have a back-end load, which is a fee when you sell your shares. There's also a thing called a redemption fee, a fee when you sell your shares. But as an investor, you should look for no-load funds if possible. And then the last one would be a 12B1 charge. So 12B1 charges are fees that are charged to cover distribution and marketing expenses. But these are just different types of fees that can impact your return on a mutual fund. One thing that you could look at is you can look at FINRA's Fund Analyzer. So the FINRA Fund Analyzer gives details on each fund's fees, and it is important to look at these fees before purchasing. Additionally, fees must be disclosed in the prospectus, so that is the document that must be filed to the SEC on these funds. And some of these fees also have share classes, and with these share classes, there's different classes of shares with different fee combinations. So the share classes represent ownership in the same portfolio of securities, but they have different combinations of fees. So let's take a look at these different share classes. In this example here, we are looking at the different classes for Dreyfus High Yield Fund in 2018, and what we can do is look at the difference between Class A, Class C, and Class 1 shares. So they all are invested in the same fund, but there's different fees associated with each share. So Class A shares, they typically have a front end fee, but they have a low 12B1 fee, so a marketing fee. With Class C shares, they rely primarily on that 12B1 fee. And then Class 1 shares, you can see, have very low fees elsewhere, but they have that expense ratio. You would think, why would you not purchase, or why would you even purchase the other shares? Well, Class 1 shares are only offered to institutional investors. Looking at average expense ratios, once again, just providing some context on these different expense ratios that are charged. As I mentioned previously, active management fees, active expense ratios are higher than passive. But this just gives you a little, or in this case, index funds fees there. But this just gives you a little context on the expense ratio of actively managed versus index mutual funds. So let's look at calculating your return on a mutual fund. To calculate your rate of return, you take the net asset value at the end of the period minus the net asset value at the beginning of the period. You add in the income and capital gain distributions, and you divide by the net asset value at the beginning. So notice that this rate of return ignores any commissions, such as your front-end loads that are paid when you purchase the fund. So this ignores any commissions when you're calculating your rate of return. Obviously, fees can have a big effect on your performance, and we'll showcase that here on the next slide. But in this particular example, we start off with an initial net asset value of $20. Our ending net asset value was $20.10. We had income distributions of 15 cents, and we had a capital gain distribution of 5 cents. What we would do is take our ending net asset value, subtract our beginning net asset value, add in the different income distributions and capital gain distributions, divide by the beginning net asset value. You can see our rate of return. Now, as I mentioned, fees can have a substantial impact on your returns on these mutual funds. So what we have here is just simply a look at 3 different funds, same initial investment, same time period, looking at your cumulative proceeds with all dividends being reinvested, and what happens here with the different expense ratios or different expense fees, and what type of impact it has on performance. As you can see pretty easily, fees have a substantial impact on your performance. This Fund A is a no load with a 0.25% expense ratio. Look at its look at its cumulative proceeds in 20 years versus Fund B and Fund C. Now, you can't see all of the expenses. One thing that you do want to be aware of is something that is called soft dollars. So with soft dollars, the portfolio manager earns soft dollar credits with a brokerage firm, and they do so by directing the fund's trades to that broker, and then as a trade-off, the broker will then pay some of the fund's expenses. And this is not included then in the fund's expenses, but it is something that is that is an expense, but you can't always see that particular expense. Now, with these mutual funds and the income that you receive, how is this income taxed? Well, investment returns are granted what is called pass-through status under the U.S. tax code. So taxes are paid only by the investor, not by the fund itself. So with these mutual funds, you are the only ones paying taxes, not the actual fund itself. And this is a disadvantage to investors because they do not control the timing of the sale of securities from the portfolio. So this reduces their ability to engage in any type of tax management. And if you have a lot of turnover, where turnover is simply the ratio of the trading activity of a portfolio to the assets of the portfolio. If you have a high portfolio turnover rate, it can be particularly tax inefficient. So for example, let's say you have a $100 million portfolio, and with this $100 million portfolio, you have $30 million in sales and purchases. So $30 million in sales and purchases. Your turnover then would be this ratio of trading activity divided by the portfolio assets. So we would have a 30% turnover. Turnover had typically been around 50%. The average turnover dropped to 30% in 2017. If you invest in a low turnover index, that may be something less than 3% as a turnover rate. And this could be possibly due to a change in investor attitudes, investing in index funds rather than actively managed funds. Now, the tax impact of the turnover must be included in the prospectus. And so what they'll do is they'll showcase the tax impact of this turnover on the buying and selling of these securities, and they'll showcase this over a 1, a 5, and a 10-year period. Now, one other thing that's similar to a mutual fund is an exchange-traded fund, or an ETF. These are a relatively new type of fund. They were introduced in 1993. And ETFs are offshoots of mutual funds in that they allow investors to trade index portfolios just as they do shares of stock. So you are able to sell it throughout the day, as opposed to with the mutual funds receiving their net asset value at the end of the day, or whatever that value may be on that mutual fund. With some examples of ETFs are spiders. This is an S&P 500 ETF. They kind of match the S&P 500. Diamonds look at or try to index the Dow Jones. Cubes index the NASDAQ 100, and then with webs they index the foreign stock market indexes. With ETFs, it used to be that they were required to track specific indexes, like we mentioned previously, S&P 500, Dow Jones, etc. But in 2008, now you can go after ETFs that have specific objectives, so they could be growth ETFs, value ETFs, etc. But they are very similar to mutual funds, except for the fact that, not simply for the difference, but you are able to trade these ETFs similar to a share of stock. Now, some potential advantages of ETFs. One, they do trade continuously just like stocks, so you have more liquidity with these ETFs. Typically, they can also be sold short or purchased on margin. They are often cheaper than mutual funds, so you would buy these ETFs through brokers, so it saves in comparison to mutual funds, the marketing expense that mutual funds then charge, and that could then result in a lower management fee. And another advantage is that they are tax efficient. So as opposed to what we said previously about that turnover with the mutual funds, ETFs, you can avoid the capital gains taxes with these ETFs, so they can be more tax efficient. Potential disadvantages are that the prices can depart from the net asset value. So with the mutual funds, we talked about how those are traded. With ETFs, their prices can actually depart from the net asset value, which can actually negate some of the cost advantages that ETFs typically offer. And they also must then be purchased from a broker, so for a fee. So this is as opposed to mutual funds that have the no-load funds, for example, with ETFs, they must be purchased through a broker. So let's just take a look at the growth of U.S. ETFs over time. You can see that the growth has grown substantially since their initial introduction. And as you can see, the largest area is U.S. Equity Broad Index. And then just a breakdown of the investment company's assets under management and what their different categories are. Yes, the predominant asset under management is mutual funds, but you can see that second is that exchange-traded funds, which is approximately $3.4 trillion worth of assets under management. So going back to mutual funds and looking at their investment performance, as I mentioned previously, a benefit of the mutual funds is that you can pick your investment towards bond funds, equity funds, but then you can leave the specific security selection to the manager of the fund. Well, how has these professional managers actually fared? How has their success actually fared over the years? So looking at the performance of these mutual funds, let's look at the performance of these actively managed funds. So these are the ones that are trying to beat some index. They have more trading that's occurring, and they are trying to they have the active management to try to beat some type of index. What index do they use? Well, they use the Wilshire 5000 index as a benchmark. So this is simply the value-weighted index of the roughly 3,500 actively traded stocks in the U.S. So it's an index of the entire stock market, essentially. And it's used as a benchmark for the performance of equity fund managers. And this corresponds to a pretty simple passive investment strategy, just buying one share relative to the market for the entire stock market. And the Wilshire 5000 outperformed average return on diversified equity funds in 29 of the 48 years from 1971 to 2018. So this is explained a little bit more in detail in Chapter 11, but the average return on the Wilshire 5000 index was 10.9%, and these actively managed funds was over 1% less than that. Now, this index that they are using as a benchmark obviously does not have any costs associated with it, whereas the mutual funds do, but it still does not erase that difference in performance. And just looking at that again, you can look at the active funds returns versus the Wilshire 5000 returns, and this is just another visual context showcasing that the Wilshire 5000 funds actually outperform these active funds when you consider all the different fees that are taken, and that it's very difficult to find mispriced securities. That's what they talk about in Chapter 11 when they talk about this active management, is this concept of efficient markets and securities being accurately priced based on their given level of risk. So last up, what we will do is conclude with where can I find information on mutual funds. So the first place that you should look is the prospectus. So the prospectus is required by the SEC and includes a statement of investment objectives that describe the investment objectives and the policies. There's also a description of the fund's investment advisor and portfolio manager, and they also present the fees and costs associated with the mutual fund. So what are the management fees, what are the 12B1 fees, etc. You can also find information on mutual funds in the Statement of Additional Information, so the SAI. With the SAI, this is something that investors must request this document. With the prospectus, you're provided that document. You're provided the prospectus when you are purchasing the fund, but you must request the SIE document. And you can also find information on mutual funds in the fund's annual report. So this is going to tell you portfolio composition, it's going to provide financial statements, it's going to provide discussions on the performance, but these are all different areas in which you can find information on mutual funds. Now, there are thousands of mutual funds to choose from. How can you gather information on these different types of mutual funds that are available? Well, you have these things that are called encyclopedias of mutual fund information. So these simply help with the search process. You can go to Morningstar.com, you can go to finance.yahoo.com, you can go to ICI.org, which is the Investment Company Institute. This is simply the National Association of Mutual Funds, Closed-End Funds, and Unit Investment Trusts. And what they do is they publish a directory of mutual funds that includes info and fees and contact information on all of these mutual funds that are available. So this concludes our discussion on mutual funds and other investment companies. Hopefully you learned some interesting and fun, valuable information. And if I can be of any help with anything, don't hesitate to reach out. Thanks, and I'll talk to you all soon.